So the way it works is, in a typical business, when you're doing your books or when you're managing your finances, basically what you do is you take your sales, whatever your revenue is. So in this case, revenue would be, let's say you buy a house for 100,000, you put, 25,000 in rehab and you sell it for 160. So your gross profit, your profit would be $35,000, assuming there's no other expenses. And what we as investors do is, let's say we have 10 of these transactions. So we make about 350,000 in revenue. In this case, let's just say sales. And then we would pay all our operating expenses. So we would pay for marketing, we would pay for our employees, we would pay for any, supplies, software or technology costs that we have. If we have an office, we'll pay for the rent, and whatever is left over, we would take it as profit for the business, whether or not you're paying yourself a salary. So that's kind of how, typical business would work. But what Profit First talks about is, they flip the model. They say, okay, you still have the same revenue that you have in your business, but before paying any expenses out of that revenue that you have, you allocate a percentage of that revenue towards profit. So it could be 1%, 2%, 10%, whatever you feel comfortable with. Basically, talks about, okay, let's say in the same example that we talked about, you have $350,000 in revenue. Instead of paying all your operating expenses, like, employee salary, marketing expenses, technology costs, your supplies, your rent, or anything else that you have, you actually take out, let's say 10% towards the profit allocation for the business. So now you have, out of that $350,000 revenue that you had, you take out 35,000, 10% of that 350. So now you only have $315,000 to pay for all the other expenses that you have. So that's the whole principle behind Profit First, is essentially all the revenue that you make, you take out profit first, and then you go into operating expenses and other expenses that you have. So this is what, typically the financials in our business would look like. You would have revenue, depending on how much volume you're doing, 100, 200, 300, or $1 million. And, we would pay all the operating expenses out of it. Then in some cases, we notice that investors are paying themselves a salary or not, then some of that would go to salary. That would be part of your expenses, and then you pay for taxes. And if there's something left over, you would count that as profit in your business. So that's how a standard typical real estate investor business would be set up. Revenue, pay for expenses, pay for your salary, pay for your income taxes to IRS and state income taxes, depending on state that you're in. Leftover is taken as profit. And your operating expenses would be marketing, employee salary, your software, your rent, and supplies. So again, in Profit First, the idea behind Profit First is, again, you have your main bank account, or you have the main operating account that you have where all your revenues coming in. Out of that, depending on how much you feel comfortable with, you set aside 10 to 15% towards profit allocation in your business. So again, let's say you have $500,000 revenue coming in. This is, your wholesale fee, your fix and flip profit, whatever revenue you might have, you take 10 to 15% of that. So, $50,000 to $75,000 out of that, and you move it literally in a separate bank account to allocate that. So basically the idea is out of sight, out of mind. If the money is not available for you in your bank account, there's a lot less chance of you spending that money. And then you take, from the same revenue number, you take some money, and then you pay actually yourself a salary, whatever you feel is fair and reasonable. You want to set, if you are working as an acquisition manager in your business, you're working as a disposition manager. So the way you want to set this up is, if you were to replace yourself as an employee, and if you were to hire somebody who would come in and replace everything that you're doing, how much revenue, how much salary would you pay? So that's kind of what you want to start out with. Again, for most of the people, it's going to be a very high number. Start out with a number that where you feel like you are actually pushing yourself a little bit, squeezing a little bit of more money out of your revenue towards salary, so you have less money left over for operating expenses. The goal with this is you want to run your business super efficiently, run the same business, make the same revenue that you have in your business, but with a lot less resources going towards operating expenses. And then you want to take some of the money and put it towards your income taxes that you have. So again, depending on what income bracket you're in or what state you're in, it could be 15 to 20%, but I just use 15% as an example. So in this case, let's say if I was setting aside, 10% towards profit, 10 towards salary, and then 15 towards taxes. So that gives me about 35% in all the revenue allocation that I have for profit, salary, and taxes. So that leaves me with 65% to pay for all the operating expenses that I have. So all the expenses that you have running in your business, your marketing, your office rent, your employee salary, everything should only come out of that 65%. And eventually the goal would be where, you keep squeezing that number from 65% to maybe down to 50 to 55%. Based on what I'm doing in my business, I'm not paying myself a salary right now, but my net profit percentage is about between 45 to 50% of the gross revenue that we have.